Emini Playbook Market Recap, November the 14th, 2025. We are looking at today's activity recap of the trading session for this Friday on the New York session. A bit of a different format today because we are going to dive into the risk reward possibilities that are within NinjaTrader. Analysis of risk reward is very important. One of the pillars of the trading methodology that we employ. So we are looking at the daily chart for the S&P, E-mini S&P 500. We are looking at the upward trend, and we are looking at the challenge to the downside, and we are estimating the response and how the bulls will respond to the bears' push towards the downside. Looking at the intraday tools is when we are relying on our tools to monitor the activity to determine which side we want to be on. In that decision-making process, we rely on a tool to measure our risk reward. And ideally, we want to measure risk reward before we get into the trade. And what does that do for us? It eliminates emotion, both before the trade, during the trade, and after the trade. Looking at today's activity, we are going to rewind the market, starting with the activity for the overnight session, going into the morning session. This is where we found ourselves at 8:30 this morning. The tool that is used is located under the indicators, the drawing tools for NinjaTrader, and it is this risk reward tool here. So looking at this for a minute, what does this give us? This gives us a measurement that we can place on our chart to look at what is happening at different price levels. So the yellow line represents the market entry that we are taking. The red line represents the stop loss area that we are anticipating, and the green line represents the profit target that we are hoping for. Again, yellow representing the entry point, red representing the stop loss, and green representing the profit point that we are looking for. And ideally, we have this on to measure so that we can identify what is possible within our trade. What we are looking at now is currency. So basically, it is telling us that at this entry point here of 66.94, the stop loss at this point would come up to 600. And that is on one contract for the E-mini S&P 500, and the profit target would be 1,200 for one contract on the E-mini S&P 500. When we are going to the upside, we would have this structure, and when we are going to the downside, we are able to flip the structure as so. So as this stands, we would see that our entry point, if we were to get in around here, and we were to have the exact same setup for the stop loss of $600 per contract and the profit target of $1,200, we would set it at this levels. We are also able to anticipate, or we're able to see what the risk reward is telling us. So we have the option of looking at either the price point, the percentage, ticks, or the currency, which is what we're looking at right now. For example, if we were looking at ticks, we would have the same estimate of risk reward, except for looking at it in currencies, we would be looking at it in ticks. So if we were to say that we were looking for 48 points on the upside, and we were willing to risk 96 points, that's what the risk reward estimate would give to us. And the same way, if we were looking at, let's say we were looking at percentage. We wanted to risk a certain percentage to the upside and a certain percentage to the downside. We were looking to risk 18% for our stop loss, and 36% is what our profit target was. So we were able to switch. Personally, it is very important to keep one setting. You can go back and forth within the ticks, but basically you were looking for the information and you wanted to be consistent. So looking at currency, we are able to see the dollar amounts that are going in and out of our account. So how would that help us if we were looking at an actual trade? So looking at today's activity and going into this market here, we do have our normal statistical tools that we use to determine whether or not we are moving dynamically in a bearish position or in a bullish position. And we are saying this morning that we are predominantly in bearish sentiment. And when we are in bearish sentiment, we get our crash barrier on the upside, giving us an indication of where we want our stop loss to be. The crash barrier is not an indicator. It is basically a statistical tool that is giving us a combination of elements, one being the average true range of the market, what has happened in the past based on the most recent candles and the amount of activity or movement that the market has moved as we have been entering into that time period. And that is going to adjust as the market moves up or down. And as the candles get larger or smaller, that barrier is also going to become tighter or larger. And we'll see where that comes into play. So for this particular activity, if we are looking at this price level here and considering whether or not to get into the short side, we have already established that we are looking for something short, but we want to get in at a place that's going to make the most sense for us. We don't want to hit the button randomly. We want to be strategic, and the risk reward helps us as a tool to be strategic. And the way that we would do that is we would set the entry point where the market currently is. So, for example, this market was 66.80. So setting the entry point here, then we are able to move our stop loss. So for example, if we put our stop loss up to this crash barrier at that particular time in the market, the risk reward calculation is telling us that we are risking $1,050 per contract in order to make 2,100 on a 2-to-1 risk reward ratio. And I didn't mention, but you can change the risk reward ratio if you are looking for, let's say you're looking for a 1-to-1 risk reward. You can change it so that it's at 1-to-1. You could put it at 3-to-1, 5-to-1, whatever your risk reward preference is. So in this instance, for us to get in at this level, that would be what we are looking at. Now, that helps us in two ways. We are able to see exactly what the trade would cost us per contract if we're getting in at that level. And we're able to see exactly what our profit level would be. So if we are looking at this as our profit level, we're anticipating the market going down to 66.60. We're able to see whether or not it's probable that the market will go down to that level, and we can adjust accordingly. What we did this morning, and we'll go forward to see what played out and how, is using this tool, we were able to set our limit order. Now, the Foundations course that we offer goes into details about the different types of orders, but in a entry point, we can either enter into a market order or a limit order. We prefer limit orders because limit orders give more control and they reduce the emotion. So this is how the risk reward tool works with limit orders. When we are looking at our entry point and our stop loss, if we decide that we have a specific dollar amount that we are willing to risk, and we know that our crash barrier is here, we can move our entry point up so that it makes more sense for us. For example, if we're only looking to risk $500 per contract on the Emini S&P in order to make 500, we move our price point up to 66.91. The market is not there at that time, but we move it up because that's the trade that will make the most sense for us. That allows us to calculate our limit order. So even though the market is at 66.80 at that moment, we could set our limit order here so that when it comes up to meet us, then we're able to be in a better position to get to our profit target, which at that 1-to-1 ratio would bring us back down to 66.80, which makes a lot more sense than when we were looking at getting in at that lower entry point. So that is the power of being able to assess before we get into the trade. What happened this morning is that we did set that limit order and we took off. That's one of the benefits also of setting limit orders, is that you can set it at the price that makes sense for you after you've done your research and your calculations and estimated what you wanted your risk reward ratio to be. And then you could step away from your machine. You don't have to watch it. You can wait for the market to come to you and fill you at the price point that you want, instead of sitting with your finger on the mouse waiting for it to come to you. So moving forward, what did happen? The market actually pulled back up while we were away from our machine, pulled back up, and it filled us right there. So let's capture what actually happened there. We got filled at 66.93. And if you know NinjaTrader, you see that these points are actual trade activities. This is where we were actually short. So at that point, we were in and we had our profit target set and our stop loss set, which was a little bit above this crash barrier here. So that's a comfortable entry point. Okay with getting in. We were able to get in at a discount. If we compare getting in at 66.80 to getting in at 66.95, we will take 66.95 all the time. So as the market went forward, it went down and then it went down and then it actually went against us. And by the time I came back to the machine, the market was here and we were at a loss. So the benefit of having the crash barrier there is that we are able to control emotions, even though we were at about a 350 level loss at that point. We're able to control emotions because we have the crash barrier there, knowing that we had already planned for a certain level of loss. The flexibility with the risk reward ratio tool also, while we are in a trade, we are able to navigate, to decide, to make decisions in real time. So as we navigated this area of loss here, if we decide that we're willing to risk a little bit more than we had initially planned for, we are able to adjust the tool in real time so that we can accommodate for what's actually happening real time in the market. And that's very helpful in terms of stress reduction and in terms of allowing us to see what's happening with the trade in real time. And we are so in real time, as we're looking at that loss position, we actually moved the stop loss up to 550. We moved it up to, which gave us a little bit more wiggle room to see what was going to happen with this particular entry. And as we move forward, as we move that stop loss up to give us that breathing room, we see that the activity actually began to come down. Then the question became whether or not it would continue to bounce off this level as it did at 8:30. When we were in the trade, it was a little bit before 9:30, and the market had the potential to go back down, but we didn't know. We don't know in real time. So as it went down, having already had a shakeup and a loss on screen, actually, we got out right about here, which was about $100 per contract loss, which was okay in terms of the possibility of being wrong and making adjustments in real time. It was an okay loss that we are willing to take as full-time traders. As we move forward, we see that the market continued to go up, and then at 9:30, when the New York session opened, we go and we get this huge candle down. So that is the activity that we are able to gauge, and we're able to use our tool to make those decisions in real time. So getting into the trade, we see that the tool gives us that leverage to see where we want to place our targets to keep us safe from overpaying for our trade. to keep us in a position where we're able to know and calculate exactly what we want to lose before we get in, and to set our profit targets to see if there is a possibility of us hitting our profit targets. And that's happening in real time. And that's a huge boost when we are eliminating emotion from our trading. And looking back at this trade, if the point that we would have kept up here would have held and we kept that, we would have eventually reached our target. But the truth is that it is better to have a solid methodology and to operate in real time than to have a hesitation based on what this did eventually. So in real time, we had no idea it was going to do this. And then moving forward, we see that as soon as it went down, it went right back up. So it was much more fun taking a $100 loss per contract than if we potentially would have moved our loss up to here, which was a possibility going back up to this zone here from earlier in the market. We could have potentially set the stop loss at $1,000 per contract on the E-mini, which is where the market eventually went to. And we also could have set it here where we initially had it. Instead of operating in real time, we could have kept it at 550, which would have been a $550 per contract loss on the E-mini S&P. Operating in real time and using the risk reward tool, we adjusted and we came away with a $100 loss on the E-mini S&P, which is great as we see the market continues to go up. So at this point, we get the next opportunity, which is as the statistics change and we're seeing more bullish activity come into the market. How are we able to use the tool on the upside? Well, we flip this so that we are able to see the activity and the price point that we would like to get in as the market is going up. And that was the challenge that we went into going into the later morning as the market pushed up. For example, when we were here at 67.49, our crash barrier was an extended distance away. And we can see that if we were to measure where we would have needed to get in, if we got in at this market level, we would have been looking at a $1,700 stop loss point on the E-mini S&P, which is not fun and not desirable. In order to get the same amount on the upside, which would have meant that the market would have had to travel from 67.50 all the way up to 67.80, which in real time, we have to gauge whether or not that is possible or not. But before we get there, just the large stop loss point of what the crash barrier is telling us, it made it undesirable. So we're sitting on our hands during the rest of the morning session without a place to get in. Now, what can we do with the risk reward tool when the market is up at this level here, even at the 67.53 level? We can make the analysis and calculation by moving it to our crash barrier point, which is at 67.24, and then pulling back to the price entry level that makes the most sense for us. So we pull this back, and if we determine that the most we want to risk on a particular trade is 600 per contract, then we are entering into the market at this level here. Trying to get the specifics there. 600 here. So we would set our limit order, which is what we did, set a limit order at 67.36. That's where we want to get filled. That's where the market makes the most sense for us. And that's where we are the most comfortable based on our risk reward scenario. So we're calculating what is possible versus what we want at that time. So as we had that limit order, and as you have limit orders on, there will be times when your limit order does not get touched, which is 100% okay. That is a part of the trading world. So as it was set here, The market continues to go up, 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 up. In real time, we can make adjustments to the risk reward tool, bringing it up to a entry point here. And we always set our stop loss point first. So as our barrier goes up to 67.35, we can move it up to here and then anticipate with a $600 loss per contract, setting our entry point there, and then looking for our limit order to come to that particular point to meet us. And as we see, as it adjusts, the market did not meet our desired level. It continued to go up to the strong activity that we see that it ultimately had. So two ways to use it, both getting in and also managing. And when we are assessing today's activity, we are looking back in two ways at this initial small loss that we took earlier in the day. Two ways we could look at it. Actually, three ways that we could look at it. We could look at it as the could have made if we were to hold that position, or we could have had this spike down. We would eventually got our price target, or we could look at it. Oh, we could have. So the problem with looking at it that way is that that introduces greed and it takes us out of our trading element. If we look at what we could have made, that causes the emotion of greed, and then our future trades would be tainted by that feeling of greed, and we won't be on our discipline and structure that we would have needed going into the afternoon activity as the market was continuing to go up. The second way we could have looked at it is we could have looked at what we could have potentially lost. If we would have said, oh my gosh, there was a possibility that we would have lost $1,000 per contract. If that's 5 contracts, that's $5,000 lost in a morning. If you're going through those types of mental gymnastics, that introduces the second element of emotion, which is fear. And that fear would also taint the future trades that you would take going forward. Just knowing that there was a possibility that you would have lost that much, that would introduce you to hesitate when it's time to push the button for your next signal. So those are the two scenarios that we don't want to look at this loss with. What we do want to look at this loss with is that it was very well planned out. We executed properly. We waited until the market came to our price point. We had a excellent limit order when we set this limit order, when we were back down here and we were anticipating the market continuing to go down because of all of this red activity. We set our limit order at a powerful place so that the market came to us and gave us what we wanted. And we also managed well as we were seeing this activity happen with the market going against us. We managed the trade tremendously well. We were able to minimize our risk and protect our capital. The number one rule of the game is capital preservation. Without that, we are not trading with anything. So this is what we go forward with when we were looking at assessing and monitoring and making our journals about what happened during the day. We traded well, we stuck to our rules, we managed our positions properly, and we had the proper mindset going into the remainder of the day, even after taking a loss early in the morning. So the power of the risk reward tool and using it to our benefit. And we will get into more details of the risk reward tool and then looking at it in real time and the power that it has to keep us free from the emotional side of trading. Hope everyone had a wonderful trading day this Friday, November 14th, and we look forward to going into next week's activity. Have a good night.